Bob, thanks so much for joining me on the back of US earnings season. I'm looking forward to chatting today all about the companies that have reported and some of the trends that you're seeing. But I'd just be interested to know, before we get started, how would you sum up US earnings season in one sentence?
Yeah, thanks for having me on, Bella. In one sentence, astounding, incredibly strong. If you actually look at the revenue beats, I was looking before this interview. I mean, it's not something we spend our time thinking about, to be honest. We think more about our businesses, if you like, rather than the markets. But I saw actually Bernstein put a piece out that 86% of companies beat on the revenue line, and that's actually the strongest quarter since Q1 2008. So it is an incredibly strong earnings season. Yep. And we went in with high expectations, and to be honest, they've been well surpassed.
Well, I mean, valuations have been incredibly high in the last probably better half of 6 months, potentially even 12 months. The S&P 500 is up over 38%. So did that worry you a little bit going into earnings season, that potentially companies couldn't meet the expectations that were being forecasted for them?
I mean, I guess I understand what you're saying from a short term or a market perspective. I mean, the way we look at our portfolios, we're looking at what they're going to be earning in 5 years. So we know over the sort of that time frame, there's going to be hiccups along the way. We tend to look at them over a 3 to 5 year period. But yeah, expectations were high going in. And if I look at our companies, nearly all of them were in line or well ahead of expectations. And we've taken our numbers up and taken our valuations up. So what we've seen is, even though the prices have been moving up, those earnings are more than growing into the prices that you're seeing in the market.
I'd just be interested to know, obviously, if you look at companies on a 3 to 5 year view, how important is earnings season? Do you pay close attention, obviously, to the companies that you hold, but is it something that you materially consider when you're looking at a company?
Oh, yeah, no, it's hugely important, for sure. I mean, it's kind of health check on how the companies are going. I guess what's not important, well, less important, I would say, is that, if they miss or there's a slight disappointment, businesses are not linear things. There will be disappointments along the way. I mean, but for us, it's really around, what is the long-term trajectory? How are they talking about competition, market share, competitive advantage? How they're allocating capital? What's happening with their margins? It's a health check. It's not so much whether they, we don't think about it, they met expectations. It's more, did they meet our expectations in terms of all of those things I mentioned?
You mentioned also that you had quite high expectations going into this earnings season, and they've been met, and if not, they've exceeded your expectations. So I'd be interested to know, could you walk us through that, what your expectations were going in, how they were exceeded, and maybe you can draw on some examples of some companies that exceeded your expectations?
Sure. I mean, if you actually look across our portfolio, we really have, 5 divisions. If I think about it, I kind of think about it as an industrial holding company with 5 divisions. And if I look in the tech bucket where we got Alphabet and Microsoft, I mean, Alphabet's result was astounding. I mean, they had 57% revenue growth, and even obviously up against a really easy stack, easy comp, I should say, last year with COVID. But on a 2-year basis, they grew 26% per annum, which is astounding for a company that's nearly $2 trillion in market cap. So that was a blowout number for us. On the back of that, we took up our earnings and our estimates 5 or 6%. So that was a blowout number. Microsoft, they had 17% constant currency revenue growth. Again, astounding for such a big business to be growing at that sort of rate. There we took up our earnings and our estimates by around 8%. So those were in that bucket, just really, really strong. And as you say, went in with high expectations and more than delivered. If I think in our business services division, we got Aon there. We were kind of expecting for the year sort of mid-single digit plus organic revenue growth. They came in basically for the half year at 8% organic revenue growth. We think they'll probably do 8 or 9% for the year. So that was a really, really, really strong result. If I think of areas in the consumer space as well, like something like Nike, over a 2-year stack, they did 21% revenue growth. There we took up our earnings and our valuation, high single digits. So, we've seen, really, really strong across the board. If I look in the consumer payment space and consumer, you look at something like Visa, now their 2-year stack on payments volume was up 21%. So they're back to kind of domestic and ahead of where they were pre-COVID. I mean, obviously their cross-border business especially travel, is down over 50%. So the consumer's been really strong, tech's been really strong, business services has been really strong. So yeah, and our company's reporting fantastic results.
So you obviously had high expectations. Did that backfire a little bit, where there were a few companies that you thought would do well and then they missed out and your expectations weren't met? No,
everything was in line or ahead. If I look at something like CME, which is something I own in the portfolio, that was pretty much in line. Something like Diageo, they had very strong results, but that was kind of in line with what we were expecting. I suppose the real beats were in tech, business services, consumer. Healthcare was really strong in our parts of our portfolio as well. So no, there were no disappointments at all.
So let's talk a little bit about tech. Last week, we saw the earnings come out for a lot of the big tech names, particularly the FANG stocks. And there were certain stocks like Microsoft and Alphabet that did very well and managed to have an increase in their share price after that. But there were stocks like Facebook, Netflix, who really suffered after their results, even though they delivered quite good numbers. So did you anticipate that perhaps the market would react badly to some of that information and the forecasting that they put out? Or was that quite a surprise to you?
Netflix we don't follow at all, to be honest. It's not really on our watch list, so it's not something that's on our radar. In terms of Facebook, we obviously follow it very closely. It's a direct competitor to Alphabet. We thought their result was very, very strong. I mean, we think it's a really strong business. It's delivering to our expectations. I'm not quite sure why the market was disappointed, to be honest. At the end of the day, we just look at the results, how they delivered, and I think it was a very, very strong result. I'm trying to remember the revenue number. Would have been well over 50%. And we see, over the medium term, that's a 15 to 20% grower easily, and pretty much a market multiple. So I'm not sure why the market was disappointed. We don't really try and think too much, what's the market thinking about this? We're more interested in what do we think about it?
I totally understand that it's more of a what did the company deliver? But when the result is so good and the market reacts so poorly, does that worry you? Do you think that that's perhaps an indication of a volatile market and you need to step back a little bit? Or how do you view that?
I mean, in those types of situations, what we try and do is actually try and think of the reason why there was the disappointment, if we could put our finger on it, and obviously that's not always so easy to do. And then we try and think, is that a short-term or a long-term problem? And more often than not, if you want to buy a great business, you do want a short-term problem. The market doesn't give you many opportunities. And so if there's something that's short-term, maybe their revenue guidance was disappointing or something like that, we don't get too worried about that. What we get more worried about is there's a sign of loss of competitive advantage, there's competitive encroachment, something like that, poor capital allocation, gone and done a dumb acquisition. That's something that worries us much more than guidance that's 1 or 2 or 3% for the next quarter, less than the market is expecting.
Well, big tech has obviously gotten a lot of attention from the market, but I'd be interested to know what one stock is that you think kind of flew under the radar in terms of their earnings, but delivered very well, that isn't necessarily in that big tech sort of bubble.
Well, I guess the one that is one I've already touched on, which is Aon. It's kind of seen as a bit of a boring business. It's probably over time a mid-single-digit organic grower, but it's got terrific financial metrics. It's a 28% margin business, pretty much spending less than 2% of sales on capex. It's got hardly any working capital. They allocate capital really well. They buy back 4 to 5% of their stock every year. And so the guidance last quarter, we look at their main competitor, Marsh McLennan, both sort of businesses were talking mid-single-digit organic growth. Marsh basically came out with 13% organic growth and Aon with 11 for the quarter. So that was complete, really, really strong, and shows you the recovery that's taking place. Those businesses, really the key drivers are employment, capital expenditure. Obviously, cyber risk is becoming a big thing as well, and really, really strong result.
Were there any common themes that you noticed when the CEOs were discussing within the companies, talking about the health of the US economy, rumors of inflation, any pressure around that? Did you notice any kind of common denominator amongst those with those themes?
Yeah, there are a couple actually, Bella. I'd say, and we kind of forget this in Australia. We're still in lockdown, especially in Sydney. I mean, the US consumer is really, really opening up really quickly. So some of the things that I found interesting through For example, there will be more US tourists in Greece this year than there were in 2019. The things are really opening up. If you look at some of the payment company, volumes in the US in terms of eating out, entertainment, etc., they're surpassing 2019 levels now. It really is opening up really quickly. And I think, speaking to companies there, you kind of had this confluence of events where spring came along, everyone felt a bit better, summer's along, and everyone was vaccinated. And so the kind of the combination of the two. And then the US consumer is sitting on $2.5 trillion of excess cash. So there's a lot of money that needs to be spent. So I think that is a really key theme, and we saw it through the numbers. But what's really interesting is that's something that's been well known by the market. And actually, in terms of share price, our consumer stocks have actually been lagging. So sometimes you try and pick a theme, but the market's already worked it out. But I think that was something that was really obvious. We don't follow banks. It's not something we want to own. We don't like the opacity of them. We don't like the leverage. But it's clear. I mean, looking at something like Amex, the huge reserve releases that are there, the ability for banks, something like Amex is running with a common equity ratio of 14% when their target's 10. So there's a lot of capacity for banks to lend more money. They can't lend because the consumer's in such strong shape. They're struggling to actually lend, but there's a lot of capacity for them to lend and or for the consumer to gear up as well. It's kind of a weird recession where consumers have come out of the recession with much stronger balance sheets than they went in. So that was kind of different. And then on the inflation front, I guess, there's a lot of raw material inflation, obviously, with really, really easy, tough comps, if you like. So a company like we own Sherwin-Williams, they were running basically with raw material inflation running in the high teens for this year. And they are putting through some really hefty price increases. Took 3% in Q2, and next quarter they're putting through 7% price increases. Now, in the short term, those raw material increases are actually slightly negative. So you are going to get gross margin slippage. But actually, for the businesses that have pricing power, that's actually long-term real positive. Because what ends up happening is the raw material inflation abates, but the companies hold on to the price increases. And so in the long term, that's actually accretive to margins. So that's kind of what we saw across. There's obviously a shortage of labor. There's problems in freight. There's problems in logistics. And then there's just the straight raw material inflation.
So have you made any material changes to the portfolio on the back of this earnings season? And perhaps you could walk us through maybe an additional disposal that you've had to think about or that you're considering at the moment.
I hate to be boring, Bella. We haven't changed anything through this earnings season, to be honest. In fact, yesterday we did our first trade in 3 months. We don't trade, that much. So no, pretty much the same as what we had going in.
Fantastic. Well, that's all the questions that I have. But thank you very much for your time. We really appreciate it. And it was really interesting to get your thoughts on the US earnings season that's just passed.
Great, Bella. Thanks for having me on.